Hello and welcome to today's webinar. Findex and Class dive into Superannuation 2023, all things contributions. My name's Matt Bambrick and I'm the Client Relationship Manager for Class. And it's my pleasure to introduce our speakers for today's session. We've got Kevin Zhang from Class, who's our Technical Compliance Manager. Kevin has over 20 years of SMSF administration, tax and accounting and software development experience, with 14 years at Class as a technical compliance manager. We also have Belinda Murphy, a partner from Findex. Belinda, Belle is a partner based in Dubbo's office and has been with Findex for over 20 years. We also
Thank you, Matt. Firstly, with today's presentation, we do have to read out a disclaimer for you all in regards to the information that we're sharing today. So bear with me while we read through this. While all reasonable care is taken in the preparation of the material in this presentation, to the extent allowed by legislation, Findex accepts no liability whatsoever for reliance on it. All opinions, conclusions, forecasts, or recommendations are reasonably held at the time of compilation, but are subject to change without notice. Findex assumes no obligation to update this presentation after it has been issued. You should seek professional advice before acting on any material. Our webinar today contains general information and is also not intended to constitute legal or taxation advice. If you need legal or taxation advice, we recommend that you speak to your qualified advisor. So good morning or good afternoon, wherever you're located. So today Belle and I are going to work through this agenda with you all. So first of all, we're going to give you a bit of a Findex overview about us and who we are. Secondly, we're going to talk about some key legislation updates. And I'm sure you're all keen to hear about the proposed $3 million cap and contribution changes that has been in the media in the last couple of weeks. Thirdly, we'll go on to some strategies in the superannuation life cycle and give you a few tips and tricks of what we've come up with at Findex. Towards the end, we'll go through some solutions that Belle and I would work through in some of the client situations we do. We'll then go through a bit of an SMSF member checklist with Kevin, and then we'll follow it up with some Q&As. So if you do have a question, please pop it in the box and we'll endeavour to get to it. If we don't get to it today, one of us will reach out to you after the session. Okay, about Findex. So firstly, to begin, I'd like to tell you a little more about Findex, who we are and what we offer. At Findex, we really pride ourselves on being a holistic service offering for all of our clients. Here at Findex, we're lucky enough to offer some of the vast array of services in so many different areas, as you can see on that picture in the middle. Some of these include insurance, both general and personal insurance, financial planning, business advisory, specialist tax advisory, many others, and of course, self-managed super funds. At Findex, we do take a family office approach across the business where we collaborate with each other and the different service lines to ensure that you get the client, as you as clients, are serviced to the highest degree and the solution considers your entire financial position. Here at Findex, we have a comprehensive service that is all under one roof, and for us provides clients with a safe and holistic approach to all of your affairs. So who are we? As a part of the offering and service we offer that I just went through, we do have a vast geographic footprint. We are one of Australasia's leading providers that offers a vast array of service lines. We are innovative and always have a client-centric approach. Here at Findex, we do use the best technology to provide our one best way approach for all of our clients. The software that we use for our SMSF is provided by Class, hence this presentation, and is leading its way in efficiencies and automated administration. I can personally speak to this as our staff in the SMSF team very, very value Class and what they offer. We often joke around and we refer to Class as being the software as similar to the BMW of cars. So on this slide, we have obviously a map of Australia and New Zealand there. and it shows you, all the red dots shows you where we are located at the moment. And as you can see, the only state that we do not have an office in at the moment is the Northern Territory in Australia. We have numerous offices across regional and remote that we feel like we can assist many clients across the two countries. One of the great things that we have seen over the past couple of years of COVID is that even though we do not have an office in your town, technology has allowed us to help even more clients with the help of Zoom or Microsoft Teams. We have to have some positive of COVID, right? Okay, let's now focus on a little bit more about what we at Findex SMSF provide for our clients and our trustees. So at Findex, we offer the whole service in SMSF. We complete your financial statements. We prepare and lodge our annual returns to the ATO to ensure they're happy with us and are happy with you as trustees. We do offer many ancillary services such as new fund setups, BAS preparation, pension documentation, and many more. But for me, the most exciting part of our SMSF team is that we have numerous licensed advisors across Australia that can help you with the really exciting part of super. Now, I'm a bit of a nerd in this space and love to do strategy and technical advice. It's not straightforward. We at Findex can help you get the most out of your fund so that you have a really safe and happy retirement. Lastly, because we look after over 6,000 SMSFs across Australia, we have a very strong and efficient audit process. We really strive to have a strong relationship with our auditors to engage that we have a process from start to end as efficient as possible. The audit process can be a little daunting, and they definitely sometimes aren't our favourite people, but in our SMSF team, we take that hassle away from start to end. Now I'm just going to hand over to Belle now, and she's going to go through the lovely $3 million cap that we've all been hearing about. Over to you, Belle.
Thanks, Sal. So I know this is what everyone's been waiting with bated breath to hear a bit more around. And the reality is what we probably see here on these slides is what we all know in the industry at the moment. And it's what we're hearing in the media, and it's probably what's come out in the Treasury papers of late over the last couple of weeks. So I'm just going to work through a few slides that may give you a bit more detail, and it may be applicable to you or your clients, and an easy way to actually talk them through if and when this does get proposed legislation gets passed, how it might fit in with them. So what we do know is that they are proposing that we are looking at an extra tax on anyone that has a total super balance of greater than $3 million. Now, this additional 15% tax is on earnings that exceeds that $3 million, and they are talking that it's not looking like being indexed. So for a lot of you, you know, lots of the thresholds that we have in super have recently or proposed to be indexed. In this case, they are talking that there won't be any indexation, which is causing some talk, obviously, in our industry. Now, what we're looking at is 15% of tax up to the 3 million. So that's no different to where we are right now, right? The additional 15%, which will bring it to the 30, will be for those that have the total super balance of greater than 3 million. Now, what we know is that this will apply from the 25-26 income year. So the first time that we're testing it is as at 30th of June 2026. Members will have the choice of paying this tax personally or from their super fund. So it is an individual tax, and we are likening it a lot like to the Division 293 that most of you will be familiar with, that some of our clients might be paying already. Totally governed by the ATO, so they will receive a notice, is what we're being told, in the same sort of stance as those Div 293s are coming out now. We we know from records that this will probably only affect 0.5% of all Australians, so about 80,000 people. Personally, I think that number may be larger than that once we get to that 2026, but it will be interesting to see in our own client bases how many might be sitting in this space. So how do we calculate this proposed extra tax? So the calculation method really, if we can think of it in three different phases. So the first being the earnings. Let's work out what that earnings are. The second phase being what's the proportion of those earnings that corresponds to those funds over the $3 million. And the last phase being what is the actual tax then, that extra tax that I'm going to have to pay. So if I touch firstly on the first bit, the earnings. So what we know is it will be what our total super balance was in the current financial year, less what our total super balance was in the previous year. We're going to add any withdrawals and take off any net contributions. The second phase being the proportion. Now this is a percentage. Will be what our total super balance at the current year, less that $3 million threshold, over what we had at the start of the current financial year. So that will come out of it as a percentage. And this will make a lot more sense when I work through a work example in the next slide. The tax liability then, what's the actual tax I'm going to pay, will be 15%, which is the rate that we're looking at extra, times by the earnings that I've just touched on in step 1, times by that percentage that I've just worked through in step 2. So let's put all of that together into an actual reworked example. So what we have here is Ben. So Ben's 52. The first thing that comes to mind for me there is probably Ben hasn't met a condition of release. And I know with a lot of our clients through panic and media, etc., the first thing that might be coming to their mind, if they do have super balances of greater than $3 million, is to look to pull that money out of super. Now, if I think about Ben here, not meeting condition of release, that's not obviously a strategy for him. So we've got Ben, he's got a total super balance of $4 million on the 30th of June 25. He doesn't make any contributions to super or make any withdrawals, just for the ease of the exercise. And on 30th of June 2026, he's got a total super balance of 4.5 million. So that maybe have grown because his share portfolio has grown, as an example, over that year. Now, how do we work out what additional tax that Ben's going to pay? So if we go back to that three-pronged approach, firstly, we're looking at the earnings. So what did Ben have at the end of the year, less what he had at the start? 500,000. Then we go to the second approach. So what is the proportion of those earnings over the $3 million as a percentage? So what we take is what he had at the end, less the 3 million threshold divided by what he had at the end, gives us that 33%. So we know that's the proportion percentage we're using. And then bringing it down to, okay, what tax are we, extra tax has Ben got to pay in this year and prepare himself for? So we work that out as 15% tax rate times by the earnings of 500K by the proportion of the earnings of 300. So Ben's looking at an additional tax of 24,750. Now, as I sort of touched on that first slide, we know that Ben can pay that personally, that tax, or he can elect to have that tax paid from the superannuation account. So I'm sure there's going to be lots of questions on this, but that's the 3 million in a nutshell. So now moving on to what actually has been legislatively changed from the 1st of July 2022. And I'm going to touch on the unused concessional contributions and what we're doing with our clients and how that might be applicable to yours. And the downsizer, which we have also heard about for a few years now. And then I'm going to pass on to Sal, who's going to talk about the abolishment of the work test, increases to the non-concessional caps, and what strategies we're doing with our clients to reduce tax for themselves and particularly their beneficiaries as well. And lastly, some changes to the transfer balance account cap limits. So if I touch on firstly the unused concessional cap amount. So this has been in for a few years now and was originally brought in by the government to probably capture in its first instance women that maybe were going back and forth to the workforce purely around having families. And there were years, obviously, where they weren't able to contribute to super, and to give them the ability when they did return from the workforce to be able to do more than what they were allowed to in that 1 year, so to speak. I also find that I use this a lot, this strategy, with a lot of my clients that might be primary production. I live in and work in a rural area, so I have a lot of primary production clients, and therefore they have lots of cyclical years where they have good income in some years and not so in others. Also, self-employed people that would be in a very similar situation in some cases. So for this example, basically in a nutshell, it is allowing us to bring forward any concessional contributions that we mightn't have used in previous years into future years and be able to claim a tax deduction for it. So we know our limits at the moment are the $27,500 for concessional contributions. This strategy really comes into play and making sure that we're really keeping an eye on this one, where we have total super balances of less than 500K as at 30th of June the previous year. So we need to be really sure that when we're talking to clients around this strategy, that they actually do have the total super balance. So we need to make sure that we're taking into consideration all super that they may have and not just limited to the one. Now, if I move on to probably the next slide, we'll give a bit of a worked example of how this might work. So we first kicked off with this in the 18-19 year, and we can see along the top there we had concessional contribution caps of 25,000 for the first few years, and then of late it's increased to that 27,500. Now, the next line actually outlines, in this case, what a client actually made into super. So we had a limit of 25, 25, 25, and you can see in that next line what they actually contributed, 5, 15, 15. Now, in that 21, 22 year, this might be an instance where I might be returning or back from the workforce, or I might have had a really good year in my business, and I've decided that I haven't used up to my limits in the previous year, and I'm going to put a bit more in this 21, 22 year. Now you can see there's a couple of things with this. So it will roll after 5 years. So we can see here in this 21, 22 year, 32,500. So they did put in an extra $5,000 on top of their concessional cap, which then meant that they really, if you don't use it, you lose it. So being mindful to keep an eye on that with clients so that we don't obviously have excess contributions, and making sure that we're really keeping in line with our caps. So this is sort of a rolling average that obviously, working with your super teams, we obviously have transparency over where this sits. So really good strategy, this one, to be able to save some tax, particularly in your personal tax situation where you may have sold an asset outside of super. So that might be where you might have a capital gain in your own name, or you normally do have a tax problem for whatever reason. This might be a really good strategy. Moving on to the downsizer. So the downsizer, as we know, has been around for some time, and it originally did start with the age limits of 65. So for us to be eligible for this downsizer contribution when it first was announced, we needed to be 65. We know that that did come back down to the 60. And now from the 1st of January 2023, members aged 55 or over are eligible eligible to make a downsizer. Now, have we had our doors bashed down with a heap of 55-year-olds knocking on the door to actually utilise this strategy? The answer is no. And, you know, from our perspective, it probably is because in a lot of cases, there's still a lot of families rearing children, young children, teenagers, etc., that are still at home, where mum and dad might be still, you know, 55 or even older, and so they're not looking to, you know, downsize while we've still got a whole heap of kids at home. So that's sort of my take on why we haven't had the doors knocked down. But further to that, there is some other really crucial checklists that we need to make sure that we're ticking off if we've got clients that are eligible for this downsizer. So firstly being, we do need to be over the age of 55. We can contribute $300,000 from the sale of our primary place of residence into super each, so 300 each person. We do need to make sure that we've owned that home for 10 years or more. And a big one here for me is around making sure that that contribution's made within 90 days of settlement. So I've recently just had one actually that, you know, they came and talked to us. We went through the checklist. We had it all, you know, checked out. Yes, they were eligible. And the client made the contribution 3 days after that 90 days. So that obviously rendered them ineligible under this downsizer. So making sure that we're really ticking off on all of these is really important. So now I'm going to pass back over to Sal, and she's going to talk all things non-concessional caps and the removal of the work test, which is really exciting for us.
Thank you, Belle. So, yep, I do have the exciting slide today that as someone that's been in super, so Belle and I have been in super for 20 and 15 years respectively. So for me, this is one of the most exciting rules that the government has come out, and that is the removal of the work test. So just to recap, the non-concessional contribution cap for the 21, 22 and 23 year is $110,000 per year. So the rule that changed was that from 1 July 2022, you're no longer required to meet a work test if you contribute and if you're aged over 67 to 74. Now, just recap what the work test meant. So any clients that were aged over 67, if they didn't meet a work test, which was 40 hours in 30 days, they were ineligible to put any further money into super, regardless of their balance. Now, the exciting part here is that we actually have a lot of clients that do either come into inheritances or they sell assets on the end of their journey of life, and that money just has to sit out in their personal names. So with this removal of this work test, it has opened up so many opportunities, and it may open an opportunity for you sitting there today to think about, do I have more money outside of super? Is it worth getting it in there? Because remembering that the tax rate in super when you're aged of that level and your balance is under 1.7 million is 0%. So really sit back today and think if that may apply to you. So we'll acknowledge that if you do have a balance over $1.7 million, you are ineligible to put any more contributions into super of the non-concessional state. So I'll work through the next couple of slides, but it'll give you some opportunities of how this actually works. I will just note there that if you do want to have a concessional contribution, you still need to make sure you meet that work test to be able to claim that deduction in your personal returns. So here's a really cool example, and apologies for my excitement, but I do love this stuff. So an example here is Katrina. She's 70 years old. She's retired. She has a total super balance of $1.4 million at the 3rd of June 2022. She's just recently come into an inheritance of $200,000 from a family member. Now, this is a very common and real life example that happens all the time, more than anyone would realise. So before the work test was in play, prior to 30 June 2022, Katrina was ineligible to make a contribution into super. So the key points there is she was retired, she was over 67, and she had $1.4 million. So that contribution in pre 30 June 22 would have had to have stayed into her personal name and pay tax on the earnings of that at her marginal rates. Now, the exciting part from 1 July 2022 is that now Katrina would be able to contribute that $200,000 into her super fund. Her balance is under 1.7, which means she'd be able to commence a pension on that. So the tax rate on the earnings for that would be 0. Now, if that doesn't make you excited, I'm not sure what's going to. So the next one we're going to work through is the tax reductions for super beneficiaries. And for Belle and myself, the most common question that we would probably get from clients is, what happens to my money when I pass? Now, there's lots of different terminology out there, but unfortunately, if your fund, if you pass away, your fund could be eligible for a death tax. Now, no one here sitting here today would want to pay any extra tax when they don't need to. So this example here is actually a real life example of a client I have here in Albury, and I'll work you through and try and explain the best we can of the outcome of what we've achieved for this. Keeping in mind that this strategy that we've put in place, which is called a recontribution strategy, is now so much more applicable for clients that are aged over 67 to complete this and save death tax. So in the column there at the start, we have the financial years 2015 down to 2022. I've got my client's dad and mum. The balances there, if I work in the line of the 2015, their balances at the marginal tax rate for death tax, which is the 15% plus Medicare, so 17%. If dad was to pass away, mum and dad were to pass away together, the tax that they would have had to pay, or their beneficiaries would have had to pay, was $82,000. Now that is a lot of tax for someone going to their beneficiaries, and if we can help save them that amount of money, that's what Belle and I love to do. If we go down each of the years, you can see that that number there moves downwards. And if I get to 2022, what we've been able to do, and we've got a couple years more still in play for these clients, is we've managed with a strategy called the recontribution strategy to save these clients in excess of $70,000 in death tax, which just means that their beneficiaries are going to have more money from their mum and dad to utilise, to invest, and to make their future more sustainable. So for this client, we've got 2 more years left to play before these clients are 75, and that death tax rate there will end up as 0. It's a super exciting strategy, and if you would like any more information with this, please reach out to Belle and I particularly. The next one we'll work through is our general transfer balance cap changes. So as Belle referred to earlier, the $3 million rule doesn't have any indexation, but our transfer balance cap does. And that's pretty exciting, particularly this year and next year. So the transfer balance cap from 1 July 2023 is moving from 1.7 to 1.9 million. Now what that means is if you have already utilised your transfer balance cap, now that could have been at 1.6 at the 2017 super reforms that we had, or the 1.7 in the last couple of years, you actually aren't eligible for any more of that transfer balance cap. Do we think that's crazy? Absolutely. Can we change it? We can't. If you've used a portion of your transfer balance cap, then you're actually eligible for an indexation amount between the 1.7 and the 1.9. Now the calculation for that definitely isn't an easy one. It's a bit complex, but there would definitely some space there to move and to utilise. And then lastly, if you haven't yet commenced a pension, you could be eligible for a 1.9 million transfer balance cap at 1 July 2023 at 0% tax. So a little bit of a tip and trick here for you is if you are thinking about retiring or are thinking about starting a pension in the next couple of months, I would highly, highly recommend that you actually think about starting that at 1 July. And the reason for that is if we start it today, your transfer balance cap is 1.7. If we started in 3 months' time, your transfer balance cap is 1.9. So you're allowing yourself to get $200,000 worth more in that cap at 0% tax. So have a think about that one. If that applies to you, I would definitely think about holding off. Now I'm going to hand back to Belle, and she's going to go through the Lifecycle of super, which again makes us really excited because it does start from when you start working. Over to you, Belle.
Thanks, Sal. And how exciting are those strategies? So What I normally do, and this is a really visual aid really more than anything, that I bring out, particularly with new clients, around the strategies of the superannuation life cycle. And in most cases, if we can try to start to talk to our clients from a really young age around superannuations and the benefits that they may have now and through to retirement stages, it's a really good trigger, because what a lot of people think is, particularly when we're young, is that super, it's such a long way away till I can actually touch it. So I'm just going to park it and not think about it. However, if we look at this visual aid, and more than happy to share this, it's a really good tool to use. If we've got clients that are sitting in this between 20 and 35 years age bracket, they're really starting on their super journey. So they might look to maximise contributions early, because for some young people, they do have some clear goals on where they want to end from a retirement perspective. And we might be thinking about salary sacrificing or making personal contributions now, really to maximise that, particularly if we've got some high net worth individuals as well. And they mightn't have the families or things like that, other commitments at this early stage. So it's not usually the top of their mind, but if we can get talking to them about maximising things at this stage, it's really beneficial. So then we move obviously down to the 35 to 55 year age bracket. Now we might be starting to think about when we might want to pull up stumps, or what age that is when we might want to start to think about retirement. We might start to think about, are we in the right investments for us to meet our goals when we retire? And we might be looking to seek some maybe financial advice around strategies, or even investment advice at that stage. So this is also a really tricky sort of age bracket, because normally at this stage, spare cash or disposable income's usually quite tight, particularly with families and commitments around home loans and schooling and things like that. So usually cash flow is quite tight. And we then move into obviously the 55 retirement. So this is when we can really start to talk strategies. We can start to think about what age is we can meet those condition of releases, and start to access our super, and what strategies we might be able to start saving some tax for ourselves or our beneficiaries. And it's really where we see our clients start to really take control of their super really, and maximise their super benefits as they're starting to get closer and closer to that age 65. So the 65 then, probably through to unfortunately death, is where we also really do a lot of hand holding. So Sal and I talked about a lot about this week. This is a stage where normally we have some really good relationships with our clients, but we're starting to see that we're bringing in the next generations as well. So they're starting to get interested in helping parents through their the financial journey, and actually getting involved as well. Now, that also will be around estate planning decisions, around maybe death benefit decisions. But we will always see the benefit in bringing the next generation through at this stage, because as you can see, my arrow from 4, in a lot of cases with some of my clients where we do have the generational relationships, is that they may want to keep this structure, particularly if it's a self-managed super, obviously, and keep that generation and that structure going for their own families, and starting to contribute and start that cycle again. So a really good visual tool there that I get a lot of value and my clients do too. So probably for me to finish off before I hand over to Kevin, how can we help? So as Sal's just discussed, we've got a huge range of advisors across Australia and New Zealand that can help benefit you and your clients. We do a lot of identifying with opportunities and health checks with self-managed to make sure that we're ticking off, not from just a compliance, but more so from an advisory perspective, making sure that our clients are aware of all of these changes that constantly seem to happen in super and how that may apply to them, and how that we can start to work with them in utilising these strategies to the best of their advantage. So I guess in a nutshell, to finish off, please, if anyone's got any individual questions or any strategy things they want to talk about or questions, please pop them in the Q&A, which I can see there's lots of questions in there already, which is great. Our Sal and myself email is on the will be on the back of the presentation, and thank you very much for having us. We've loved being able to talk to you all things super. So I'm going to pass on now to Kevin, who is going to talk you through some practical applications of the class software and how all of this might link in for you when you're actually using your class software. Thanks, Kevin.
Thanks, Belinda. Let me share my screens. Okay, I'm going to go through a checklist of onboarding a new member to a self-managed super fund. It's all wonderful to implement those pension and contribution strategies. I want to go step one back and basically focus on the basics, and that's actually getting all the information into the systems. Now, this checklist actually applies to anyone who actually want to set up the self-managed super fund. So all the members, trustees, the members' details need to be review this checklist. Or a new member join an existing self-managed super fund, that member's checklist, this checklist also applies to that member. Or if you work as an accountant or administrator, you're taking a client from another accountant with a pre-existing self-managed super fund, you need to go through this same checklist. Now, obviously, total super balance, this is a vital piece of information you need to know in order to determine the eligibility of the member to process any non-concessional contribution, spouse contribution, and government co-contributions. Sally and Belinda already covered the catch-up concessional contribution strategy. So now you need to build the histories from effectively FY 2019 to 2022, all the contribution histories this member has made. If the member has triggered bring forward rule, then you need to capture those non-concessional contribution details and the amount that exceeding 110,000 that trigger bring forward rule. If a member has commenced the retirement phase income stream, it's very important we need to know the transfer balance account information, particularly the personal transfer balance cap and any available cap space that's available. Now, given if the member has commenced retirement phase income stream, one piece of information you need to know is the pension account or pension account identifier. This just in case if you ever receive a release authority from the ATO, you know which pension you need to commute the excess amount to comply with the release authority. Finally, for any Findex clients as well as any class customers, we highly recommend that you use SMS data flow as your electronic service address. There are only 6 self-managed super fund message providers that's currently in the market that support SuperStream contributions as well as rollovers. 2 being Australian Service and Clear Super, they are pay service. 4, they are related to either software or admin services, which means that the accountants or the administrators that have to use the software or the admin service in order to use the electronic service address. While it's not compulsory to use SMS data flow as your preferred ESA provider, I want to take, if you do want to use it, obviously you can take advantage of the SuperStream contribution coming through the data feeds automatically, but more importantly, it will allow you to actually process SuperStream release authorities and rollovers in a compliant way. Now, the next bit, I actually create a simple case study, and this case study will involve capture this key information associated with a member. And I will then show you what does that look like from the ATO perspective and how to capture the information in class. Now, John Smith, initially this is a single member fund. He's age 65, retired on 1st December 2021. He recently married Jane. She's age 60. Jane is joining the Selman Super Fund as a new member. She currently has got $200,000 in upper fund, which she intends to roll over to the Selman Super Fund. Now, I break down the John's superannuation details. So he's got 432,000 total super balance. He had trigger bring forward rule in FY21 being $180,000. And for simplicity, I had his concessional contribution details all the way back to FY29 being 20,000, 21, and 1,000 increment each year. So 86,000 altogether for the last 4 years. Finally, he started retirement phase income stream on 1st December 2021 with $400,000. Now, Jane recently actually returned from UK after working overseas for decades. And it's a very extreme example where she has not made any concessional contribution for the last 5 years. Now, she's currently working as an IT security manager with a very high salary of $260,000. The SG, which is the superannuation guarantee, which is set at 10.5%, which means she has to contribute $27,300. Now, given her taxable income is already over $250K, she's liable to Div 293 tax anyway, which calculates to be $4,095. Now, imagine she adopts the strategy on the right where she either do salary sacrifice or make a personal deductible contribution equivalent to the amount of unused concessional cap, which is $102,000, being $25,000 times 3 years plus $27,500. So if she make that contribution, the Div 293 tax is actually the lower of the contribution times 15% tax, or the excess amount over above the $250K, which calculate to be $5,595. Yes, she actually is liable to pay more Div tax, which is exactly $1,500, but the amount of tax savings she made as bring her taxable income from $260K to about $160 is a whopping $29,500. More importantly, by doing this strategy, her super balance is effectively increased from roughly about $223K, which is 200 plus her concessional contribution less the contribution tax, to about 330K. And I deliberately made an example for her to be age of 60. Now, if cash flow is a problem for her, she can potentially start a transition to retirement income stream anytime in FY23, and she can actually take some of the money from the super to supplement the income due to, say, cost of living or lifestyle choice. She got that flexibility. Now I'm going to move in class to show you how to capture those information easily through the class software. Okay. Now, firstly, this is online service simulator from ITO. Either you are a tax agent of individual, you're able to access the superannuation information for the member through the online service for tax agent. But majority of our clients, if you are only tax agent for the self-managed super fund, or you're a financial advisor, it's very hard to get that information. But I will show you if you do happen to see that information or help your client to get information, and this is what you need to do to get that. Okay, hopefully it works. So I assume your member will have access to MyGov, and this is when they log in, this is what they see. All the super related information sits in here, super information. So you have your total super balance, you have your carry forward concessional contribution details, and you have your transfer balance cap information. And if you do trigger bring forward rule, you can also capture there. And I'll quickly go through this an example where you can see the total super balance breakdown by each year and the historical data. And if you go to have a look at the carry forward concessional contribution. Again, it's breakdown to the financial year. F23, this one doesn't have records yet, but I'm using this one as an example. And you can see the cumulative unused concessional contribution available carry forward. So unfortunately, that information is absolutely important in order for any advisors or to provide any contribution and pension strategies. And similarly, this is your transfer balance cap. And this will give you your personal transfer balance cap. So this member started retirement phase income stream previously with 864, I assume from 1st July 2001, it got a proportional indexation, and that's why it's no longer 1.6, 1.646, and the valuable cash space for her is actually 782,000. Now, how do you actually bring that information in class? I just load this fund in class. Now, obviously, the easiest way to update that information for a member is go to member contribution caps area. And you can update the concessional contribution information, bring forward rule details for John or Jane. But there's another way a lot of people may not be aware. This is our Excel fund loader. And this is the tool we use for anyone who want to transition a fund to class. They either do it themselves or our transition service team will provide that service for them as well. So, and we have built that functionality over the last couple of years, but not everyone's aware of. Now, this sits actually under the contribution history tab. So John, if I just key in this information, and 20,000, and he has triggered bring forward rule of 180,000. You can actually update all the information here. And one of the advantages using the loader is if you have 6-member fund, you can update that information in one go. Similarly with T-bar history, because he actually launched the transfer balance cap reporting information outside of class, you can create that information, the historical data here. And that pension started from 1st July 2021. Now, there's a status. You can choose lodged or not lodged. So lodged means this will only be reflected in class as an adjustment. Not lodged, this will actually create a manual T-bar event and a T-bar records for you. Potentially, you can download the record and lodge through online service for tax agent. Now, once I update this, and you can actually submit that information. Now, the contribution history, it actually sits under this column. We have a 2-factor authentication. Let me just copy this. Get the code. Copy the code. Just press here. Now I can basically submit John's historical contribution details to class, and then I can also submit his T-bar records to class. And then I'll quickly show you what's that look like in class. So if I just close this and member contribution caps. So he got all his historical concessional contribution here. He triggered bring forward rule, and it will tell you which financial year is triggered. For Jane, obviously she has not made any concessional contribution. Her cap space for cumulative unused cap is actually 102,500. Finally, and I'll show you the T-bar histories. So don't have to submit. Let me just go back and refresh this. Oh, I submitted twice. So basically the T-bar history is there. He's got $400,000. Given I made a mistake, I submitted twice. You can easily fix that in class as well. Simply go to browse events. And change the manual T-bar events. And just delete one of them. And then if we go back to T-bar console. So because he started income stream on 1st July, his transfer balance cap is actually 1.7. With 400,000, that means his available cash space is $1.3 million. So that's all I want to share. I will hand back to Matt Bambrick to go through some Q&A.
Thanks, Kevin. A couple of questions that we've had come through. If we're all happy to go through them. Just a reminder, we will send out a recording of the presentation and slides after as well, and answer any questions that we don't answer now. So question, could a member who's over 67 use the unused concessional cap amounts in year 3, carried forward from year 1 and 2, given year 1 and 2 are not meeting the work test? If anyone would like to answer that?
So I'm just looking at reading through this again. Could a member who's over 67 use the unused concessional contribution in year 3 and 4 carried forward from year 1? So if it's in the 5-year period, if your super balance is less than 500,000, so it's not based on age, you can use the unused concessional contributions. Yes, so as long as year 1 hasn't dropped off, you can use what you have not used in the previous years. Given 1 and 2 not met the work test. Yes, correct. Yep.
Thought we might look at the question below that. So there was a question about slide 11, Ben's example.
Yeah.
In that formula, should we presume the member will need to pay an additional 15% of tax?
Yeah.
If over 3 million?
Yeah. So basically, I think the question here is around is the 15% tax on basically unrealized gains. So yes, that is what they're saying. So it's based on what your member balance is. So you're paying tax on basically assets that you haven't sold. So that is probably the second contentious issue that's out there in the market. The first being no indexation, and the second being that, yeah, you are being penalised or taxed on something that you haven't sold. So yes, the increase in the member balance was because the shares went up, but nothing was sold. Yes, it will be included in that balance.
Moving down, how is a defined benefit pension value being included in the 3 million cap?
So the Treasury paper has actually said they're going to give us some more information in this space around defined benefit. So we really don't have any more information at this stage on that, but watch this space. I'm sure it's going to take a lot more time than just normal super, so to speak, to work out how they're going to work that tax out, I think, because it is different.
Okay. A few more. Just to confirm, the concessional contributions over 67 still need to meet the work test?
And confirm that one, that is correct. You do need to meet the work test to put in a concessional contribution in.
If the TESB decreases year on year, like 2022 versus 2021, and there is a loss, does this trigger a tax refund or carry forward of the loss?
So it's my understanding it definitely won't trigger a tax refund, but the losses will sit there to offset the years where there may be a gain, so to speak. Yep.
This is a good question. Does it make sense to transfer any excess over 3 million out of super into a trust?
So I would say in that one, it really depends. So it depends on the tax implications of where you want to move it to. So for a few clients that I've talked to around this, well, fair few actually, is it's still in my mind even though it is, yes, it's tax and it's an additional tax, it is still an okay gig at 15%, rather than, you know, you pull it out if you invested it in your own name, or you invested in another structure, maybe you're going to be paying a lot more than, in some cases, 15%.
What we do need to remember on that one as well, Matt, is that we are getting $1.9 million worth of income at zero tax rate. So we've really got to keep that in the back of our mind, is that it's only a proportion over 3 million that we're going to get that 30% tax.
A couple more. If there was a transfer to pension account of say 1 million in FY22, when the transfer balance cap was 1.7 million, does this limit remain at 1.7, or will there be a proportionate increase from 1 July 23?
There will be a proportionate increase on this if you haven't utilised your cap. So if you haven't utilised the cap up to 1.7, you will get a portion of that increase from 1.7 to 1.9. The calculation for that is tricky, but yeah, the answer is yes.
Fantastic. Question for Kevin. If the original Excel data loader has been submitted for opening balances, can you later add in the T-bar and contributions information, etc., and resubmit?
The answer to that is yes. The T-bar history is independent. You got extra button. The contribution history, despite it's using the low open balance button, you can, if you already run a period update or close the financial year, the contribution history can still be submitted and updated in the contribution cap area, independent of whether you run a period update or close the financial year. So the answer is yes.
Okay, great. Maybe just one or two more. In terms of downsizer, if we sell a property for 280,000, can I top up the contribution amount to 300,000?
So the downsizer will only be the 280. You can obviously make non-concessional contributions or concessional contributions for the top up, but no, you can't top it up and call it a downsizer. It would just be the 280 that could go in.
Okay, fantastic. And in terms of the downsizer, if my partner uses the downsizer now, can they use it for our new house in 10 years' time?
Yeah, so I guess I've had clients do that where one will utilise it for the sale of their primary place of residence now. They might move to somewhere else and stay there for the next 10 years, and then the other partner use it next time round, particularly if they're young and they've got 20 years up their sleeves.
All right, awesome. All right, we might wrap it up there. In terms of any questions, details are up on the screen. We will send out a recording of the webinar as well as a presentation, and we'll follow up any questions that we haven't answered during the webinar as well. So thank you all for joining. Have a good afternoon.
Thanks, everyone.
Thank you.
Thank you.